Well, stocks rallied once more last week as the dollar continued to rebound and the curve steepened further after a hotter than expected US CPI figure, plus a rather messy weekly US jobless claims report. Another busy week awaits for market participants now, with eyes beginning to turn towards the ECB, who are set for back-to-back 25 basis point rate cuts at their meeting on Thursday. But a busy economic data docket is due besides that, plus earnings season steps up a gear as well. Plenty to discuss on the trade-off this week. Without further ado, let's crack on with the show. So it was a busy week last week. This week has started in slightly quieter fashion, but I'm sure it will get relatively busy in pretty short order. Joining me, as always, to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. And Ryan, it seems like you've spent most of this quiet Monday looking at restaurants that you can take me to next week.
Yes, well, it's a bit of a strange one for viewers that don't know. You lost another bet to me, and I've somehow ended up paying for it. But I don't know how that works. But yes, looking at restaurants, we're looking to go Peruvian this time around, so something different.
Indeed, I'm very much looking forward to that. But before we get there, we've got not just this week, but also next week to get through before we can, put our feet up and let our hair down. Well, I'll let what's left of my hair down. I'm not sure you'll be able to do the same. In any case, let's crack on with Topical Thunder. I love how you're coming prepared to this show now.
Yeah, I'm well prepared this week, mate. Don't you worry about that.
Oh, good. Nothing going to be dropped on the floor, hopefully, during today's recording. Right, let's crack on, because it was an interesting week, actually, last week of US data releases. We had I think arguably a situation where the market is finding it as hard to balance employment and inflation as the Fed seemed to be, given the reaction that we saw to the CPI print and to the jobless claims metrics last Thursday. In terms of the data itself, headline CPI came in unexpectedly hot, albeit showing continued disinflation at 2.4% on an annual basis in September, down from the 2.5% that we saw previously. The core metric, probably a little bit more worrying, coming in at 3.3% on an annual basis, a tick higher from the 3.2% that we saw in August. But I think what was perhaps more concerning for markets, at least judging by the immediate reaction to the data, were the weekly jobless claims figures. And this showed that initial claims rose by 258,000 in the week to the 5th of October, while continuing claims rose by 1.861 million in the prior 7 days. So you've got hotter than expected inflation and much worse than expected jobless claims. I think it's important to not overinterpret the data, because certainly policymakers at the FOMC will seek to to watch a trend in the data rather than overreacting to one data point. And it's also important to recognize that the claims figures, they were heavily skewed by the impact of Hurricane Helene, which hit a number of southern states in the United States during that specific reference week. Now, of course, this week's claims data is likely to be even more skewed by Hurricane Milton, which battered Florida last week. And of course, it's also important to bear in mind that this week's claims number, that coincides with the October non-farm payroll survey week, so does increase the downside risks to the October jobs report, which is due on the 1st of November. Now, it's not just employment data that's going to be distorted by some of the recent weather events. Think about things like inflation. Prices will be all over the place. Retail sales, consumption trends are going to be, frankly, a mess as a result of some of the destruction that these hurricanes have wrought. So I think, in short, the message really is that incoming US economic data is going to become horribly messy for the next quarter or so. It's going to be quite tough to discern some signals from among all of the noise that we're seeing. And of course, you've got to remember that this is coming at a pretty delicate point in the economic cycle, where the market is pricing less, or fully pricing, I should say, less than 25 basis point Fed cuts between now and the tail end of the year. So I think it's going to be, it certainly raises the stakes in terms of volatility around some of these key US releases over the next couple of months.
Yeah, absolutely. And I think the market's, pricing less than 2 cuts when Powell's told us he's expecting 2 cuts. Again, is just a sign of that boat running situation where the market runs from, the more dovish side when we were pricing 50s to the other side where they're pricing out cuts as well. The data, we always have to take the data for what it is. I was surprised at that jobless claims move, but that was the market showing its hand, how focused it is on jobs data at the moment versus inflation data. I didn't agree with that market move. I actually tried fading it in dollar yen. Not that was the right horse to pick it. It was like rodeo riding, trying to trade that one over the data. But yeah, it was a bit of a surprise. I did suspect maybe there was some weather impact in that, and like you say, we're going to have to expect that moving forward. I think the weather, although it's an easy excuse now for the market to throw out bad data, it was weather related, I still don't think that will change the Fed's mind. If anything, given the devastation we've seen over there, it might even encourage the Fed to cut or make sure they cut, just to give some easing to those householders and people who've lost houses and whatnot, just to ease the burden a bit there. So if we get bad data and the market goes, oh, it's weather, and we see it bouncing the dollar and rate expectations easing further for cuts, I don't think necessarily that's the right move to take.
No, I would agree. I don't think it's going to materially alter the Fed outlook. I think just the distortions in the data could cause a little bit more volatility in the market than we might otherwise expect. In any case, the next Fed meeting is not for 3 weeks. We've got the small matter of an ECB meeting later on this week.
Yeah, and not an event we're particularly looking forward to, as it seems.
Are we ever?
Sorry?
Are we ever?
No, have you put the day off yet?
I'm not allowed.
Good. I might. It seems that the Guard and a merry band of governing council members have managed to suck all volatility out of this meeting with their usual take on forward guidance, which is each of them speaking about 30 times between meetings. With that said, any new news that we get and that we need for price moves will come in the statement and the presser. And I think there's a few key items that we need to look out for in that. Firstly, a rate cut this month is a bit of a shift from making announcements or decisions at forecast meetings. That's something they've liked to indicate so far, that they would prefer to go at forecast meetings when they get more data and more updates. That tells us that perhaps they are a bit more worried about further economic weakness and the speed that inflation's coming down. Maybe for them it's coming down a bit too fast. So the first big question will be how big that worry is. Now, if they are worried, are we about to see the ECB cut cycle picking up speed? Will they indicate that cuts may come at every other meeting now, or every meeting from now on? Are 50 basis point cuts going to be considered? We're definitely going to play that game. Personally, I don't see 50 basis point cuts being on the table for an actual announcement, but it'll probably get some lip service in terms of the usual, won't rule anything out. So with the deposit rate expected to come down to 3.25% this week, that really only gives them maybe 3 or 4 more cuts of that size before the rate is at a reasonable neutral level. And thus, there's no real need to pull out any 50s in the first instance. So with only the December meeting after this, which is a forecast meeting, they might use a cut this month to see them through to the new year, given that they expect inflation to pick up into the year end. But overall, I think if you're looking at it, they're probably going to indicate what they're going to do for the new year, or leave that till the December meeting. Overall, I think there's a risk of some euro weakness if they do indicate they're going to go faster, but it may not amount to much if they start detailing where rates are going to perhaps stop.
Yes, I think the ECB, well, I always think this, but I think they're going to be quite boring on Thursday, to be completely honest with you. It would be tough to justify this data dependency that they claim to have and not cut if you look at the data. Headline inflation is now below the 2% target. Growth is rapidly falling off a cliff. The composite PMI was at a 7-month low in September, and you only need one look at German economic data to see that worse is likely on the horizon. So I think you're absolutely right. A 25 basis point cut is pretty much baked in. They're not going to pre-commit to any particular policy path, as they love to tell us. But I think this really does set the course for a 25 basis point cut at every meeting, and then they probably get to neutral early on next summer and go, what do we do now? I don't really think that there is likely to be the potential for surprises. I think 50 basis point cuts are probably off the table for now. And it's very much a case of 25 every meeting and unless and until the economy picks up. But there's certainly no sign of that on the horizon anytime soon. Although I do think it's interesting. And I know this is something that you've mentioned a few times. We did hear from the French central bank governor Villeroy last week, and he was probably the first ECB governing council member to actually start talking about the potential for undershooting the inflation target. And I thought that was just a little bit of an interesting sort of nuanced change in their language recently.
Yeah, and as you know, that's my one of my big focus points for next year. It's all right getting rates down to a level you want to keep them at, but the economy's got to play ball. And if, we've got inflation already below target and we're not even at the end of the year, what's going to happen if it keeps going over the next few months ahead? Then that's really going to put question marks over the neutral rate and where the ECB are going to stop cutting rates to.
Yes, indeed. And obviously only time will tell on that one. Moving on, it's not just a busy week in Europe, it's a busy week here on this side of the channel as well, with a handful of key UK economic releases due, setting up some framing ahead of the next BOE decision, which comes on the 7th of November. Tuesday morning, so this data will be out by the time you watch this show, I would imagine. We get the latest labour market figures very early on tomorrow. Unemployment, that's expected to have held steady at 4.1% in the 3 months to August, although earnings pressures should continue to cool, with both overall and regular pay growth seen cooling by around about 0.3% apiece compared to the levels that we saw in July. Of course, do bear in mind that the ONS, for some inexplicable reason, still cannot produce accurate labour market data for the UK economy. So take the figures with a little bit of a pinch of salt. Moving on. On Wednesday, we'll get the latest inflation numbers. Headline CPI, that's seen rising by 1.9% on an annual basis in September, back below the 2.2% target after jumping to 2.2% in August. There were a few one-off impacts in that number: energy prices, some base effects, and also the impact of another round of Taylor Swift conferences distorting the data somewhat. We are expecting a continued fall, or a renewed fall, I should say, in some of the underlying inflationary gauges as well as a result of those effects fading. Core inflation, that's seen down at 3.4 from a prior 3.6, and services, which is something the BOE watched very, very closely indeed, that's seen at 5.2, down from a prior 5.6%. And then, of course, the week wraps up on Friday with the latest retail sales figures. Headline sales, they're seen falling by 0.5% on the month in September at a headline level, the same magnitude of a decline expected excluding fuel. And I think one of the things I'll be focusing on in that retail sales release is whether we see a slump in spending on some of these bigger ticket items, and that could just be the first sign of a little bit of spending restraint and a little bit of uncertainty creeping in ahead of what's likely to be a pretty grim budget on the 30th of October in terms of tax hikes and government spending cuts. Looking at how the market views that next BOE meeting, we currently see the curve pricing around a 93% chance of a 25 basis point cut in November. I think that's pretty much nailed on at this moment in time. What's more interesting is December. Markets see that as a 50-50 chance for a second 25 basis point cut after the November meeting. And of course, that comes after Governor Bailey was talking the other week about being potentially a little bit more activist in terms of delivering rate cuts if incoming inflation data continues to behave itself. And I think if we do see particularly that core and that services inflation metric come in below market expectations, you are going to see quite a substantial dovish repricing, and subsequently you'd expect some pretty chunky headwinds facing the pound as well.
Yeah, I think that the market's going to look at this data through that Bailey lens from last week, where he ticked the possibility of getting a bit more aggressive. So if we do see weak data, then people are going to think, oh, well, he's had the heads up on that, and that's why he's sent out the comments. And really, the pound hasn't recovered at all since then, since those comments, particularly euro, sterling, and cable certainly haven't got back to levels we were pre-Bailey. So, yeah, I'm not going to be up for any of the data. I might be up for the CPI data. Of course I'm not. I might be up for the CPI data because that'll be probably the most important one of the lot. And yeah, we get to see is inflation coming down below target, or is it going to be a bit more sticky? I don't know what to make of those wage numbers. There's still an awful lot of public sector pay deals, whether they're going to be impacting or not. Obviously, as soon as Starmer came in, he handed off pay deals to some of the NHS staff doctors, and then we had this deal with some of the rail unions as well. But then we've got other potential strikes and pay deals going on. So I don't think we've seen the last of the wage argument, shall we say, and higher wages. So I think that might continue to be more sticky.
Yeah, I would tend to agree with that, and I don't want to turn this into a political broadcast, but of course the precedent that's been set by effectively saying go on strike and we'll give you what you want, it does raise the risks that we do see continued rounds of above inflation public sector pay rises, not just this year for those who haven't had their pay settlements yet, but also into the next financial year as well. May I also take this opportunity to reassure our viewers that I will be up for all three of those data releases, sat at my desk about 50 yards away in there. So don't you worry, at least one of us is fully committed to the cause. In any case, our producer's already moved our graphics on. I think he's giving us a hint to tell us to hurry up and get on with it. So we probably should.
Yeah, well, you know, they say move on quickly before you say something awkward. So yeah, let's go on to economic data. And what else we should be watching this week? Michael's done a good job of covering all the UK data. I'm going to look at some of the other important data this week. Tuesday is going to be important for the Bank of Canada because we get the latest Canadian CPI data. Markets running the pricing between a 25 and a 50 pip cut for future meetings at the BOC. So this data will definitely play into that. Headline CPI is expected to rise a point to 2.1%, whilst most of the 30 different core measures they like to use are largely expected to come in unchanged.
We know why that is, by the way.
What's that?
It's trim core, median core, BOC core. It's all a load of rubbish, isn't it?
Yeah, it is. Are you going to have another rant? Do I need to?
No, I'm not.
For a minute.
Don't worry. No.
Sure, you done?
Yes,
okay. All right. No puns. No puns. I'm ready.
No,
no puns either. Okay, I'll crack on. Yeah, we get Kiwi CPI, New Zealand CPI later in the evening on Tuesday, and that again is going to be important after the RBNZ went a 50 pip last week. This data will be key as to whether the market assumes they're going to go another 50. They release this data quarterly, so there's always a bit of space in between the numbers. So this is Q3 data, expecting in at 2.3% from 3.3% prior, so coming down quite a chunk. This week also kicks off the October manufacturing data. US Empire State and Philly Fed numbers come Tuesday and Thursday, so watch those for an early insight into that currently weak sector. The big data Thursday, though, is US retail sales. Now, this September survey period might not have included any of the hurricane effects from Helene, but it will still give an idea of how the consumer is faring ahead of the big upcoming holiday and shopping periods to come. On Friday, we see another flood of data from China, including GDP, investment and retail sales. With a lot of focus on stimulus measures at the moment, this data might well show how deep a hole they need to dig themselves out of. Obviously, this data isn't going to reflect any of the recent stimulus measures. And then later on Friday, we get housing data from the US with housing starts and building permits. And this may be one of the data points that will show some of the impact from the Fed cut, because it's just coming around that time when they did cut. So we could start to get some data from the US that, as I say, reflects that 50 pip cut. But as always, before trading the data, read them in terms of the trends and what those mean for the central banks. Yes, you can react to each individual data point, whether it's a hit or a miss, but bear in mind what it means for the bigger trends.
Yes, indeed. That's very important. I think of all of that, I think US retail sales is the one I'm going to be keeping my beady eye on the closest, plus, of course, the jobless claims print that we referenced earlier. And just for some more context around that, of course, that drops in the sort of half an hour intermission that we have between the ECB decision and the ECB press conference. So that could be a very busy half an hour or even longer for financial markets, depending on what President Lagarde has to say. The Canadian CPI figure is going to be interesting, although I think the chances of a 50 basis point BOC cut have been diminished marginally after a better than expected jobs report on Friday. The economy added about double the number of jobs were expected, unemployment down to 6.5% from a prior 6.6%. So I think that has lessened the chances of a dovish surprise from the BOC next week. But yeah, certainly a bit of a sort of week that has something for everyone, isn't it?
Yeah, and it's funny you mentioned those rate expectations, because after the Canadian jobs data, the expectations for a 50 got cut from somewhere like 51% down to 38%. And then right after we got the business outlook survey, which was still showing a little weakness, it went back up to 50% again. So, yeah, I don't know why they would suddenly step up to a 50 after doing three 25s on the trot. They're on their path and they're going to stick to it. But this is the game we're going to be playing, that pendulum swinging, and the market, as usual, probably getting too dovish.
Yes, very much so. Right, let's move on to some charts. So I want to kick things off with the dollar this week. I was talking last week about how the dollar was a little bit of a sell on rallies trade. And, well, you only need one look at the chart to see how badly that's worked out. We've bounced solidly from the, as near as makes no difference, the bottom of this 2-year long range a couple of weeks ago. And it's been a pretty relentless run higher for the greenback. At one point last week, we'd notched 6 straight daily gains, which we hadn't done for a couple of years. And we are approaching a bit of a key test for the bulls now around the 100-day moving average, which comes in at 103.25. Now, I think the move is interesting because if you look at the what the market is pricing in terms of rate cuts, as we were mentioning earlier, less than 2 cuts fully priced in by the end of the year, things do still look a little bit too hawkish on that front. But it seems like the foreign exchange market is back into a mode where it wants to buy into growth. And I think the action that we've seen to kick off this week sends that message quite clearly. Some weakness in the Aussie and the Kiwi dollars after another disappointment in terms of Chinese fiscal stimulus over the weekend really just speaks to how the market is again buying into this theme of US economic outperformance, US exceptionalism, rather than focusing on the rate outlook, which has become relatively synchronized in terms of the pace of cuts across G10 FX. If we do get a break north of that 100-day moving average, and a closing break, of course, then that would be make the outlook considerably more constructive from a technical perspective for a prolonged move to the upside, with obviously the 200-day lurking above at 103.75. A failure at this level would leave still a little bit of hope left out there for the dollar bears, but I think the balance of risks does, at this moment in time at least, continue to point to dollar upside. And as we've said so many times this year, the trend seems to be your friend.
Yeah, very much so. We were discussing this in our chat room this morning, because it does feel like particularly after the China opium trade, that the market is perhaps looking around where the growth is. There's no growth in Europe. There's little growth in the UK. China, as we know, is struggling. And the only place that does seem to be going among the major economies is the US. And if that's the case, then we're going to see flows going there. And that's happening. Strangely, we're getting dollar strength even while the Fed, one of the biggest central banks in the world, is cutting rates. So it gives you an idea of, it's not always not always a straight correlation to say, oh, a central bank is cutting rates, so the currency is going to weaken. And we're seeing exactly that effect here.
Yes, indeed. Well, speaking of China, a clear expression of that is what's going on with the Aussie dollar, of course.
Yep, it's the Aussie dollar, and I've been looking at this one. This has been one of the key currencies in terms of the Chinese opium trade, and it's looking like it's on a bit of a knife edge at the moment. That opium effect has washed out since the highs following the big PBOC rate cuts, moves, and all that stimulus, and we're now sitting on a really big support level. Around this 67 figure, we have the 38.2 fib of the August swing up, 55 daily moving average at 67.15.17. So 2 numbers there, 2 technical indicators really close together. Then we have the 67 figure, which has been a level all on its own. Then we have the 100 DMA down at 66.93. Now, we've been stuck down near these low levels going on for 5 days now. And while that's potentially good news for buyers that we've stopped going down, the bounces do look pretty weak off the level. They're being limited to around a 67.50, 60 area, and that keeps the pressure on this support. Going forward, I think traders have to go with whatever way we break from here. Above 67.60, and we go back and look at the 68 level. Below 67.90, we might see a fairly quick drop to, the 61.8. Below 60. Got my numbers now. Below 66.90. That's the one I'm looking for. We might see a fairly quick drop to the 61.8 fib, though we do have some traffic. Excuse me, around 66, 60, 80. Now, despite how negative October looks so far, technically, we're still just in pullback territory in terms of the August uptrend. So the picture still remains bullish over the medium term. And if we do hold this support and break a bit higher, then that trend's going to continue.
I've got to disagree, I'm afraid, given what we were just saying about the greenback. But also, two things. One is the Aussie dollar is the most liquid China proxy out there. And let's be honest, I think no matter what the Chinese government or authorities announce, they're never going to meet the incredibly high bar that markets have set in terms of expectations. Certainly not when they keep hosting press conferences just to basically say hello to the media and not actually announce anything. And the second thing is the RBA are one of two G10 central banks, along with the Norges Bank, who have yet to make even the most modest of dovish noises. And I think it's only a matter of time before they're going to have to sort of fall into line with their peers. And that is, you would expect, going to pose some headwinds to the Aussie as well. So I would be looking for further downside here, personally.
Yeah, well, I'm actually short, as I'm going to talk about a bit later. So, yeah, I'm not really talking my book on this one. I'm just presenting the analysis here that, we're at an important juncture. So if we can't go down, there's only one other way we can go. And if we can't go up, again, there's only one way we can go.
Indeed. Well, we have a trade-off first after 2 years. Ryan not talking his own book. Let's frame that one.
Doesn't happen often.
Exactly. Let's move on to the equity space. The S&P notched a fifth straight weekly gain last week. Excuse me, I've got a frog in my throat. And I've just had a headline pop up on my phone here that we've hit a fresh intraday record high as we move through the cash opens to start a new trading week. The path of least resistance clearly continuing to lead to the upside. Of course, earnings season now the main risk for markets to navigate. We heard from JP Morgan and Wells Fargo on Friday to kick off third quarter reporting season, both beating expectations and setting the stage for what is likely to be a relatively strong reporting season up ahead. Of course, the market still has faith in the Fed push and also still has faith in a solid pace of US economic growth, as we were discussing earlier. So I still see little reason to believe anything else than dips are likely to remain shallow and continuing to be seen as buying opportunities. One thing that has caught some attention, I've had a few people talk about this, is why are equities rallying when the VIX is at 20 or 25? The reason is the VIX looks ahead over about a 30-day window in terms of implied volatility, and that now encompasses the election, which is obviously just 3 weeks away. So you are seeing a lot of hedging activity around the election, which is pushing implied vol in early November higher, which is having the effect of sort of artificially inflating the VIX. The fact that the market is rallying at the same time as the VIX is moving higher is not, in my mind at least, any sort of sell signal or harbinger of doom, as you've seen some people on the internet talk about it as. It's purely a sort of mechanical thing with how the index is calculated. So, long and strong still in terms of the US equity market.
Yeah, you've been pushing this one for quite some time, haven't you, mate? And every time we do, I've got nothing much to add. We keep making new highs. There is nothing to throw against this stock market at the moment. But one thing I perhaps would caution is as we're getting closer to the action, maybe we start to see a bit of decent profit taking. The market still, I don't think it knows what's going to come from any of these contenders. We know that Trump's been a bit more open on some of his policies, looking to end double taxation and things like that. So that's probably adding to some of this positivity. But as we get to crunch time, probably 2 weeks before that election, then maybe there's going to be a few more wobbles in the stock market, or probably not.
Well, indeed, we shall see. It's a weird election, though. It's a really weird election because, we're sat here 3 weeks out, and I was talking to our very good friend Ryan Paisley earlier on, PIQ Suite. Go and have a look if you haven't already. And we were both saying, and it may be a function of the fact that we live on this side of the Atlantic, but the media don't seem particularly interested. The market doesn't seem particularly interested, and policy detail is incredibly thin on the ground. I mean, I would say a lot of what we know about the election is almost assumed based on the stereotypes of each party rather than necessarily what either candidate has actually had to say. So yeah, it's a very, very strange one. And to be completely honest with you, I think with 3 weeks to go, we're certainly not going to get much more clarity now.
No, probably not. And they don't tend to put out manifestos like everyone else, do they?
Not as much, but you would have expected a little bit more in terms of some of the stump speeches, at least in terms of, actually setting out their stall in terms of policy and all that kind of thing. And it just doesn't seem to have happened, unless, of course, it's managed to pass by, every single market participant out there, which I think is a bit of a long shot.
Yeah, exactly. They just seem intent on slagging each other off. Well, leave them to it. That's what I say.
Exactly. Right. Why don't we look at the equity market a bit closer to home?
Yeah, I'm going to look at UK equities. And, you mentioned it earlier, things are looking pretty dim or grim for the budget news at the moment. And I'm looking at the FTSE 100. I was in two minds whether to look at this one or the more UK-centric all-share index, but I'll stick with the FTSE 100. It seems like we're getting into full-on budget mode at the moment. And so if you're trading UK assets, you need to keep on top of the news. The latest headlines, for example, were that the capital gains taxes, national insurance, could be heading much higher. And that's not good for firms, and it's not good for investors. We've already seen reports that there's been apparently a 6% increase this year on UK business owners looking to speed up selling their businesses, again, to get in before some of these tax hikes. Bank of New York, they reported that custodians have sold the largest amount of gilts in September since the Truss event. So the trend at the moment is looking obvious that investors are taking a bit of a dour line into the budget. Now, for stocks, we're not yet seeing any real negative impact. That may reflect some of the trade-off between some pain that might be coming in, but there's also the other side in which the government might be supportive of growth. So it's a bit of a trade-off between negative on the tax side, positive on any growth boosting measures. But it's all sounding like a bit of hopium at the moment. So the FTSE 100 is full of international firms and listings, so it's not an overly good indicator for purely domestic events. But as this budget's likely to impact both sides, both domestically and foreign firms, it's one that we should be watching for sentiment clues, if anything. I think the trade is pretty simple from here. If we're breaking up through the 84 highs, be it before or over the budget, then the market is feeling good about that budget. If we're under 8,000, again, going in or over, then the sentiment is looking far more negative, and you have to go with which side the market moves on that. We're still 2 weeks out from the budget. As I say, that's now in the zone when these headlines really might start to move things.
Yeah, we're definitely getting to that point where the market is starting to focus on the fiscal side of things more. And if we're being honest, it sounds like the budget is going to be pretty grim. We've got this rumoured 39% capital gains tax rate, and also now, as you said, talking about increasing the employer national insurance contribution, which sounds incredibly complicated, but effectively it's just going to make it more expensive to hire people. So what a firm's going to do, they're probably going to hire fewer people. I think one point that actually I was talking with a few colleagues earlier, the messaging does seem to be quite clever around the budget, because Initially, we were talking about CGT rates being aligned with income tax. So you're talking about the potential for as high as 45%. We've now got reports that it could be as high as 39%. So if Rachel Reeves stands up on the 30th of October and says, we're going to have to put capital gains tax up and it's going to go to 34%, well, a lot of people are going to go, oh, thank God for that. It could have been a lot worse. And actually forget that it's still 15% higher than it is now, and it's still going to kill investment. So there is a little bit of political strategy and game playing going on here, obviously, to fill this imaginary £22 billion black hole that the government have come up with. But yeah, the FTSE's kind of gone nowhere for 3 or 4 months now. I think the fiscal backdrop certainly, and the uncertainty doesn't help that. And to be honest with you, it seems like when you take the spin away and you boil it down, the budget is only going to be bad news, I think.
Yeah, and that's one of the reasons why I'm paying for lunch before the budget, so that I can use the expenses to reduce my capital gains obligations in case they do hike them. So I'm serving two purposes here.
Oh, there we go. Well, hang on a second. We can go somewhere nicer now, somewhere more expensive. I want you to reduce that tax obligation as much as you can, mate. It's all for you. Don't worry.
I was expecting you to anyway.
Right, beers on Ryan in a few weeks. For now, let's look at our plays of the day. Okay, so what are we looking at this week? Well, I'm looking at treasuries, first of all, specifically the 2s, 10s segment of the curve. We saw a renewed bear steepening of the yield curve last week after that hotter than expected CPI data. And this is momentum that I would be looking to ride. So you buy the front end and you'd sell the long end, with the front end likely to continue to rally as Fed pricing seems to have moved too far towards a hawkish extreme, as we alluded to earlier on, while the long end, you would expect further selling pressure to continue as those rate cuts come, with GDP growth continuing at a very rapid clip indeed. Of course, the labour market remaining relatively tight, even if incoming data has been somewhat distorted. And of course, with inflation still north of that 2% target, and the UMich data that we had on Friday indicated that inflation expectations are still a little bit lofty. So in terms of the Treasury complex, steepeners are still my preferred play on the Treasury curve. Ryan, we are going back to Australia.
Yeah, back down under, because I thought I'd do a bit of a follow-up on my play of the day for last week, just so it gives an idea how I manage a trading plan. I started shorts last week for two reasons. One, for the more short-term play on the market, I thought getting too dovish over the RBNZ. The second, for a bit of an RBA play. Well, the RBNZ part didn't go according to plan, as they ended up going a 50 in the end, but that was always a possibility. I had factored that into the trade. Now, as the price had already dipped from my entry around the 110.40s prior to the RBNZ, I had a bit of margin to play with over the announcement, so I wasn't that concerned if they then did pull a 50 out the bag as they did. I was, and I remain, offered up into the 111 area. That hasn't been filled yet, and now we're just sort of mooching around my entry point. I'm happy to stay short in this and add more at my key levels up at 111 and into the July highs around 111.50 and prior highs, and that level you can see on the chart, 111.70s. There's a chance that the Kiwi CPI that comes out tomorrow helps me getting filled in those higher levels. Obviously, if it's a much weaker number, then the market's going to ramp up the 50 pip cut game again. Otherwise, I'm mainly watching this from the RBA side, and as Michael mentioned earlier, whether the data over there starts to follow everyone else and maybe sees the RBA finally turning a bit more dovish. So still short, looking to add and see where we go.
Indeed, we shall see. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and your thoughts on anything that we've discussed or anything you'd like us to discuss in the show next week. And that is indeed when we'll be back with another episode of The Trade Off. In the meantime, have a very good week ahead, and the three of us will see you this time next week. Thanks as always, and goodbye for now.